the highly authoritarian and undemocratic responses of the European Union are based on a view that the crisis in the euro area stems from government deficits, government fiscal deficits being too large. And this seems to me to be fundamentally wrong, that the deficits of governments in Europe are a result of the crisis, not the cause of the crisis. And if we look at what the causes of the crisis are, I think we're dealing with two interlocking processes. The first process is the international crisis, which started in the United States in August 2007. The US economy has for many years had wages that haven't gone up. Economic growth has been dependent on people being able to borrow money to finance increased consumption. And in the last 10 years, European banks started getting very actively involved in this business in the United States, partly because they were being put under pressure by the European Commission's policies to become more competitive. And it seemed that the best returns were available in the United States. So when the crisis broke in 2007 and when it deepened in September of 2008 with the collapse of Lehman Brothers, European banks suffered as much as US banks. And a major collapse of the banking system in October 2008 was only prevented by massive state intervention in the banks. The financial crisis then led to a major contraction of lending. Banks effectively stopped lending even to the best customers, and that led to a major downturn in the economy in the last quarter of 2008 and the first quarter of 2009. Output fell by something like 5% in the euro area, the most serious fall since the 1930s. And in early 2009, governments in the euro area intervened to boost demand by increasing their spending and cutting taxes. But the recession also led to a major collapse in tax revenue for governments. And if we look at the figures for the fiscal deficits, this is showing the fiscal deficits as a percentage of GDP for the year 2007, before the crisis really bit. You can see that on the far left, the deficit for the euro area as a whole was about 0.5%. Every country except Greece was under 3%. Greece's deficit was higher, not because of spending, but because it was failing to tax the rich. Many countries had a surplus, including Spain, as you can see, somewhere in the middle there. As a result of rescuing the banks, of trying to counter the slump, and the major reduction in tax revenue, the deficits shot up. So that now we see Greece at over 15%, many countries are over 10%, and virtually every country over the 3% that was set in the Maastricht criteria. So here we see very clearly that the fiscal deficits are the result of the crisis, not the cause of the crisis. Now, you can see that, can you put the next one? Yeah. Yeah. That Ireland has this outstanding achievement in 2010. Round of applause for the Irish comrades. 32% deficit, thanks to the generosity of the Irish taxpayer for the people who had shares in Anglo-Irish Bank. Basically, the situation has remained the same. In 2010, you'll see that Greece has a deficit of 10% of GDP. Now, the same year, Britain and the United States also had deficits of 10%. So that raises the question of why there was a crisis in Greece and the euro area and not a similar financial crisis in Britain and the United States. And that leads us to the second component of the crisis, and that is the imbalances in the Eurozone. That since the Eurozone was set up, there have been major divergences in wage developments. That in Germany, as a result of reforms introduced by the Social Democratic Green government, real wages have not gone up for over 10 years. At the same time, with lower interest rates in southern Europe, growth was higher in the southern European countries, but inflation was also higher, but the result was a really marked divergence in unit wage costs, the average wage cost per unit of output. And the result of that is that over the first 7 or 8 years of the euro area, a major imbalance developed in trade. Could you go to the last slide? That you can see that thanks to the wage policy in Germany, Germany built up a very strong export surplus from around 50 billion euros a year in 2000 up to almost 200 billion in 2007. This was only possible because of the euro area. About half of Germany's exports are with the euro area, and if it had had that sort of surplus when it still had the Deutschmark, the mark would have gone up and up and up in value and choked off this trade surplus. So with wages flat, Germany's growth has been very, very dependent on exports, and those exports have been to more than 50% to the euro area. By contrast, the countries of southern Europe have almost had a mirror image, that the deficit increased from around 70 billion in 2000 to just over 150 billion in 2007. And this pattern of imbalances is absolutely central to understanding the current crisis. The question is, how was it possible for Spain, Portugal, and Greece to continue running trade deficits of this sort of scale? And the answer is that banks in France and Germany in particular lent them the money so that they could buy their exports. And this was clearly an untenable situation, and that was the crisis that broke in 2010. Speculation developed at the weakest link in this chain, and that, of course, was Greece, that in the first 4 months of 2010, speculation developed against Greek government bonds. The euro area authorities failed to react, and speculation intensified, including against the euro. And finally, in May, the European authorities agreed to intervene after the head of the IMF and the head of the European Central Bank had visited Mrs. Merkel and said, the situation is absolutely critical, you have to move. And only then did the German government agree to the first loan for Greece at the beginning of May 2010. The crisis was temporarily modified in the second half of 2010, but in 2011 it began to ignite again very seriously. I'll mention 2 reasons very quickly. One is German insistence that in the future bondholders would have to take losses. That immediately set off panic selling of Greek bonds, Portuguese bonds, Spanish bonds, French bonds. Secondly, it became clear to investors that if you drive countries into a recession by insisting they adopt incredibly severe austerity packages, then they will never be able to repay their loans. And the US has recognized this, the IMF has recognized it, Standard & Poor's, the rating agency, has also said that if you drive Greece and Portugal and the other countries into deep recessions, they will never be able to pay back their loans. And with this recognition, the crisis intensified. And my time is almost up, so let me just say, the EU responses, as I'm sure everybody is aware, have been dominated by a German-dominated alliance with France. On virtually every issue, Germany has overridden the French position. And above all, at the core of these policies is an emphasis on fiscal discipline. The idea that if only governments controlled their fiscal deficit, all would be well. And the highly authoritarian proposals of the EU have been referred to already by a couple of people. The six-pack agreed in April of last year, whereby the European Commission will gain really strict powers to control governments that have a deficit, not countries that have a surplus. Strict measures to control countries where wages rise more than productivity, but none for countries where wages rise less than productivity, as in Germany. And crucially, Germany has blocked a number of financial measures that could ease the immediate crisis. One would be for the European Central Bank to buy bonds instantly. That would stabilize the markets. Secondly, in the medium term, to issue joint euro area bonds. And all these have been blocked. And I think the key issue is that the problem is a political problem, and it is above all about coping with the policies of the German government, which has this obsession with a very, very conservative view of fiscal discipline.